So Steve, if I could just jump in for a second, because I can visualize some of my close clients looking at these bar graphs saying, Chris, just tell me what I need to know. So uh, clear up anything that I describe improperly here. But essentially, if I'm a mom and pop investor, 1960s constructed building, number one, my asset class is not competing against these other asset classes that have had to offer these exorbitant concessions of 1 and 2 months of free rent. And so it's not likely that I'm going to have to do so in order to get my places rented. And to that fact, when we looked at the change in the asking rents, some areas, even during this pandemic, have actually gone up surprisingly, or at least stayed the same of what they were prior to the pandemic. So in general, my rents are secure in place. And to that point, for those of you that are familiar with the city of Covina, we own a building there that we're renovating and renting. And for a 500 square foot, 1 bedroom, 1 bath, we just rented that for $16.95. I mean, that's a high rent for a small unit in the middle of this health crisis. And so rents are strong. Vacancy, while it has crept up, it looks like, again, it's impacting those areas that have a lot of new supply, or a lot of these higher end communities where the tenants have a choice given their type of employment. And I think another side takeaway of this is the winners and losers, so to speak, in terms of rent collection. A lot of it has to go to luck of the draw. Your tenants, were they essential workers? And if essential workers, they continued to work through this pandemic. And if not, and laid off, and they were unemployed because of the government stimulus, they've had $2,400 extra a month. Many people claiming to be making more money on unemployment than when they were employed. And so that has propped up the market as well.
Absolutely. And to your point about the mom and pop owner, the 1960s Class B, Class C construction, I think while we're talking about submarkets in this chart, you can take these submarkets on the right side as kind of a proxy for that type of asset, that type of property. In places like North Hills, in the San Gabriel Valley, Tarzana, virtually everything is an older Class B or Class C property. So this performance here, where you see these outlying submarkets outperforming, that is due to the strength of that asset class, the Class B, Class C sort of workforce housing, for a lot of the reasons that we've talked about, primarily affordability, demand for that kind of reasonably median price product is so strong and so consistent in LA that we haven't seen much weakness in that asset type so far. Okay, so moving on to sort of the capital markets and the investment picture. You noted early on, Chris, that you've seen a slowdown in some of the markets that you are primarily covering in 2018 and 2019. From an LA perspective, a wider perspective, we hadn't really seen that slowdown yet. We had about close to $11 billion in total investment in both 2018 and 2019. That led the entire country. So what that may indicate is that you were seeing investments start to shift from the eastern part of LA County, where, as we talked about, yields had really compressed and prices had run up. And now maybe you have bigger, deeper pocketed investors that are driving sales volume in the past few years, chasing that more institutional product in central LA on the west side. But regardless of that, you can see that the outbreak has really changed the investment picture dramatically, where every quarter after quarter for close to a decade, we had over $1 billion in apartment sales. Concluded that run has come to an end. In the second quarter of 2020, only about 800 million in sales. So investment activity didn't dry up entirely. You still had some deals getting done, but relative to what was going on prior to the outbreak, obviously a dramatic slowdown. And this is just what's taken place so far this quarter in the third quarter. So you do have some opportunistic investors maybe who've had some money in the safe or in the bank account waiting for a downturn, kind of pouncing on opportunities here. But for the most part, it seems like people are kind of content to sit on the sidelines and let the economic waters settle a bit before jumping back in.
Now, we want to take the information that we've discussed thus far and chunk it down even more granular. So going back to our corridors, the 605 corridor, which again consists of Montebello, Whittier, Pico Rivera, Norwalk, just think up and down the 605 freeway, south of the 60 freeway. What my team and I have done is looked at sales since the end of April. Now, going back a few videos, you remember back in the middle of the stay-at-home order, we recorded a market highlight video where I mentioned it was too early to tell what did this pandemic mean to values, and that we would need to track those buildings that had been listed during the pandemic, see where they eventually sold, how many went unsold, and that's the data that we're looking at now. So since the end of April, you've had in that 605 corridor, you've had 9 multifamily properties sell and close escrow. You've had you have 2 that are currently pending, and you have 6 that are currently for sale. Well, what's our cap rate? The cap rate now, at least of those that sold, is 4.6%. That is an uptick from where we were from the end of last year. In general, the average price per unit is about $232,000. Now, keep in mind, especially if you've been watching our 5-minute multifamily, there's individual markers to value a property. Price per unit is just one, so it might not be a clear indication of the value of your property, but it is one of the markers. Eastern San Gabriel Valley, again, think between the 10 and the 210 freeway, east of the 605. You've had 6 multifamily buildings sell since the end of April. 1's currently pending, 7 are for sale, and the cap rate of those that sold is 4.7. That's significantly higher, about half a percentage point higher than we were at the end of last year. East Los Angeles, East LA, El Sereno, the surrounding area there, think 710 freeway and west. You've had 6 multifamily buildings sell, 2 are currently pending, 10 are for sale. Now, I would have to venture to guess, because I own multifamily in this area as well, the reason for the significant number of buildings for sale there, because that's a lot for that area, normally you don't see that many, is aside of the statewide rent control that we currently have for all cities, non-incorporated Los Angeles County has its own version of rent control, which is very similar to LA City. And one of the components of that is a limit of 3% annual increase in rents. And in their law, it's even written that some years you may have a 0% increase depending on what inflation does. So I imagine investors are looking to, at least some of these investors are looking to exit that area. And if we're going to live with rent control, at least get into an area where they give you the 5% plus inflation, which many cities have under statewide rent control. Now for Pasadena. Now Pasadena, again, we lump in Pasadena, South Pasadena, Altadena as a submarket. 7 buildings have sold, no buildings are pending, and 12 are currently for sale. You have seen over the last 60 days a number of buildings come up for sale in the Pasadena area. The average cap rate there, 4.5%. The Western San Gabriel Valley, this is Alhambra, San Gabriel, Temple City, in this general area. Basically, it's San Gabriel Valley until you hit the 710 freeway. Again, between the 10 and 210 freeway. We've had 4 multifamily buildings sell. No buildings are currently pending for sale, and 10 are actually, so we have 0 buildings pending, meaning there are no buildings in escrow, and 10 buildings are currently for sale. Again, for this area, that's a pretty large number of properties. And the average cap rate, 3.8%. That's still a very strong cap rate from a seller's perspective. So that tells us values are still strong in that area. The 710-91 corridor. So here you'll be thinking Huntington Park, Southgate, Cudahy, Maywood, again, all the way down to the 91 freeway. You have 9 buildings that have sold, 3 are currently pending, 6 are for sale. Not a whole lot of inventory for sale, but the cap rate, the average cap rate is now touching and heading towards 5%. That is relative to the last 5 years, that's a nice yield. And I mentioned in my comments earlier, buildings are trading there because people are chasing yield, hence 5% cap rate. The Western Inland Empire. So we're talking Pomona, Ontario, Montclair, Fontana. We've had one building sell, one is currently pending, and 4 are for sale. So, and the cap rate of those that have sold are 5.4%. So again, if you're looking to chase yield, you can head to the West Inland Empire. I own myself in that area, very strong rental market. It's not what many of you might think of, a low C-class area. It's not that. Of course, it's block by block, but in general, much better rental area than many may assume if you've not ever invested in the Inland Empire. But not a lot for sale. So landlords, in general, we can say landlords must be happy in the area. And then the East Inland Empire, one multifamily building has sold, one is currently pending, 3 are currently for sale, and the cap rate there is about 5.5%. So we, as reflected in the graphs, not a lot of turnover since April. A lot of investors saying, and these times, if you don't have to do something, why would you?